Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everybody. This is Brent Foster. Today is April 30th, 2025. This is your weekly market insights. Markets react to positive trade talk. So stocks pushed higher last week, spurred by the White House reassuring comments that progress was being made on trade talks. The S&P 500 ended Friday's session at 5,525 spot 21, gaining 4.6% this week, led by technology stocks amid better than expected earnings from a number of companies in the sector, including Google parent Alphabet. The index is still down, though, 1.5% for the month and 6.1% this year on concerns about the economic impacts of the ongoing trade war between the U.S. and several countries, including China. Both Chinese officials and U.S. President Donald Trump, however, softened their tone this week. While the NASDAQ Composite Index picked up 6.73%, closing at 17,382.94, the Dow Jones Industrial Average lagged, adding 2.48%. The MSCI EFA Index, which tracks developed overseas stock markets, increased by 2.86%. Markets opened the week lower as investors continued to fret about China trade tensions, but sentiment quickly shifted. Stocks rebounded Tuesday following the news the administration intended to de-escalate tensions with China over tariffs. The rally extended through two more consecutive sessions as investors responded favorably to reassuring comments from the Trump administration. Markets also were encouraged after the president said that he had no intentions, in quotations, of firing Fed Chair Powell. They also liked hearing Treasury Secretary Scott Bessent's comments that the U.S. had an opportunity for a big deal with a key trading partner. So, U.S. Consumer sentiment waned for the fourth straight month in April as uncertainty around tariffs dampened expectations and pushed the year-ahead inflation outlook to the highest point since 1981. Final results from the University of Michigan surveys of consumers showed Friday. While the April reading was of 52.2 was down from 57 in March, it was still above the consensus view of 50.5 in a poll compiled by Bloomberg. On the earnings front, Alphabet was the spotlight as Google parent not only released better than expected Q1 results, but also said that its board raised its quarterly dividend by 5% and authorized the repurchase of up to another $70 billion in Class A and C shares. The company's shares rose by about 7% on the week. The technology sector had the largest percentage increase this week, climbing 7.9%, followed by a 7.4% gain in consumer discretionary and 6.4% rise in communication services. Financials and industrials rose by about 3% each, while materials added 2%. ServiceNow, stock that our company owns, had the largest weekly percentage gain in the tech sector, jumping 22% as the company posted Q1 adjusted earnings per share and revenue above analysts' mean estimates. The company also forecast Q2 subscription revenue above the street's view at the time. In consumer discretionary, Tesla shares climbed 18%. The electric vehicle maker's Q1 adjusted earnings per share and revenue both came in below street's views. But Chief Executive Elon Musk said he would recommit more of his time to the company. That was the biggest and best possible news investors could have heard, Wedbush analyst said in a note to his clients. And that was Dan Ives who said that. I like Dan Ives a lot. Netflix was the top performer in communication services, rising 13% as the company's Q1 results and Q2 guidance both exceeded analysts' expectations. Consumer staples was the lone sector in the red for the week, dropping 1.4%. Kimberly-Clark had the largest percent drop in consumer staples, falling 7.8%. The company reported Q1 adjusted earnings above the street's view, but is Revenue slightly missed analysts' mean estimates. Also, Kimberly-Clark reduced its guidance for 2025 adjusted earnings per share. Next week's earnings calendar features Visa, Coke, Pfizer, Microsoft, Meta, Apple, Amazon, Eli Lilly, MasterCard, McDonald's, Berkshire Hathaway, ExxonMobil, and Chevron. Economic data will include Q1 gross domestic product, March personal consumption expenditures, and the closely watched April employment report and unemployment rate information. All right. So, again, just as a review, year to date, the Dow is down 5.28%, NASDAQ is down 10.94%, S&P 500 is down 6.37%, MSCI EFA index, which tracks overseas stock markets, is up 9.73%. So international outperforming the US the first time in many, 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 many years. So don't get too excited about that because that could reverse itself. It might, but we'll see if the academics are right or if common sense prevails. Not making fun of any academics, for I am one as well, to a degree. 10-year Treasury rate, 4.29%, and that is down from a month ago. 4.31 a month ago, 4.63 3 months ago, and 4.7 1 year ago. So kind of at 4.29 for the 10-year note, and we'll watch that one pretty closely. As it creeps up towards 5, that's not good for equities. And if it goes too low, it's pointing to something dramatic going to happen in the stock market. Housing market update. So fresh housing data released last week showed that the median price for newly constructed home is $403,600. And an existing home, $403,700, were virtually identical in March. This is unusual. Typically, the average new home costs more than the average existing home, but last month, the median new home price fell while the median existing home price rose and hit a new all-time high. Okay, key economic data. I already went over all that. And then I already went over notable companies reporting earnings. A couple that I didn't mention: Welltower Waste Management, Honeywell, Spotify, American Tower, Booking Holdings, S&P Global, Starbucks. I'll be interested to see what they say. Qualcomm, Caterpillar, ADP, or Automatic Data Processing, AMZN, later on, Lilly, MasterCard, Intercontinental Exchange or ICE, KKR, the Southern Company, Stryker Corporation. There's plenty more. Berkshire Hathaway, Chevron, ExxonMobil. So I kind of mentioned some of those, but it's a very, very busy week. And that is this week, actually, given that I'm releasing this on Wednesday evening. All right, tax tip of the week: recovering documents following a natural disaster. Suppose you live in an area that's prone to natural disasters like tornadoes or hurricanes or earthquakes. In that case, it's essential to prepare, or fires. I forgot about fires. That's a big one. To manage your important documents and paperwork and know what to do if those materials are lost. Here's some tips from the IRS, which is the Internal Revenue Service. Contact the IRS or search their database online for help reconstructing records after a natural disaster or casualty loss. Download publication 547, Casualties, Disasters, and Thefts, and publication 584, which is Casualties, Disaster, and Theft Loss Workbook, to figure out your loss on business and income producing properties in the event of a natural disaster. Read publication 3067, IRS Disaster Assistance, Federally Declared Disaster, for information about how federally declared disasters affect individuals and business owners. This document also covers the assistance available to victims. This information is not a substitute for individualized tax advice. Please discuss your specific tax issues with a qualified tax professional. This tip was adapted from irs.gov. Stay tuned for the next segment. Hey everybody, this is a great article I wanted to share by Brian Boyle over at the Daily Upside. Kudos to you, man. Good article. Apple leads manufacturing pivot to India. I thought this would happen years ago, actually, when we had the first iteration of Trump 1.0, when he started tariffing the crap out of people. And he's doing it in 2.0 here. And he last time specifically picked on China. And I know that China and India have their rifts. And just through network of people that I know that are from India and stuff, I was kind of gleaning and figuring out that U.S. Reliance on China was going to have to shift, especially when it comes to supply chains. And so it looks like this has been happening ever since the Trump presidency back in 2016, and supply chains have been shifting to other countries. And India, I thought, would be a major beneficiary of that, and it's proving to be true. So, technology and big tech, here we go. So, Apple shifting production to India is just the latest sign the world's most populous nation may be a winner in global trade reordering. So, this article was posted by Brian Boyle again on April 30th. You can check it out. Thanks to the trade war, he says, Apple suddenly has a China problem. Its solution, India. So last week, the Financial Times reported that Apple is planning to shift the assembly process for all U.S. sold iPhones from China to India by the end of next year. And on Tuesday, Reuters reported that production has already started at one of the southern Indian plants, with shipments expected as soon as May. It is just the latest sign that the world's most populous nation could end up an inadvertent winner amid the global trade reordering. So an Apple plant a day. So check this out. To put a spin on the old saying, international mega corporations plan, trade warriors laugh. Apple spent decades and billions of dollars building a world-beating production line for the single most successful consumer electronic device of all time in China. And in just a few pen strokes, or shall we say Truth Social posts, the White House crushed its entire business model with 145% tariffs levied on Chinese imports. Apple, of course, has been planning ahead. The Cupertino, California-based giant has been slowly diversifying its supply chains away from the Middle Kingdom for years, opening its first iPhone manufacturing plant in India back in 2017. India now assembles about 18% of the roughly 230 million iPhones shipped every year, according to Counterpoint Research. Assembling all of the roughly 60 million iPhones sold in the US every year will likely require Apple to double its current manufacturing capacity in India, according to the Financial Times. It may just be enough for Apple to stave off raising the price of an iPhone, which has held roughly steady for years now. While data from industry research firm Tech Insights, seen by the Financial Times, suggests that tariffs could drive the cost of an iPhone 17 up 30% by the second half of the year, Morgan Stanley analysts say leaning heavier on India assembly plants as well as sharing the burden of rising costs with suppliers could help Apple maintain its current pricing. And for reference, even with a current 26% tariff rate on Indian imports, assembling iPhones in India is still likely to be far cheaper than assembling them in the US. Apple isn't wasting any time. In addition to the factory that opened Tuesday, Reuters reports that Foxconn has begun construction of a $2.6 billion facility in Bengaluru, India, which will be capable of assembling as many as 500 iPhones per hour. Still, not everyone is buying the India pivot as a perfect solution. In a note to clients last week, MoffettNathanson, analysts wrote, the bottom line is a global trade war is a two-front battle impacting costs and sales. Moving assembly to India might, and we emphasize might, help with the former. The latter may ultimately be the bigger issue. So, start of the deal, the 26% tariff on Indian imports may not hold either. So, U.S. Treasury Secretary Scott Bessent said Tuesday that the White House is very close to a trade deal with India. And Reuters reported that Indian trade officials are offering a rarely granted forward most favored nation clause to the U.S. as a sweetener to hasten talks. Perhaps India's trade negotiations have hired advisors at Goldman Sachs, who, according to the Wall Street Journal, reported earlier this week, have begun advising nation clients that any form of symbolic concessions could be enough to quickly settle trade talks. Great article. Wanted to share it with you guys. It's on the Daily Upside, April 30th. You can check them out. You could subscribe to them or whatever. But I thought it'd be worth sharing. I first want to talk about NVIDIA. Harlan Sur over at JP Morgan says, quote, "We believe NVIDIA continues to execute across all segments. While first half is typically seasonally weaker than the second half, we expect solid demand in PC gaming to be strong revenue driver for the company, offsetting PC OEM, which is in secular decline. We expect the data center segment to grow strongly as hyperscale customers continue to embrace GPU accelerated deep learning for processing large data sets. We are encouraged by strength in the automotive and enterprise segments as well. Although strong adoption of autonomous driving in the market remains to be seen, we anticipate significant upside in shares, driving our overweight rating." So, valuation, our December 2025 price target of $170 a share for NVIDIA assumes that NVIDIA trades at a 30 to 35 times multiple applied to a $5.20 of annualized earnings power, citing current year 2025 earnings $1.3 times 4. Our earnings multiple is consistent with its potential earnings CAGR of 30-35% plus over the next few years, led by continued strong data center growth, monetizing incremental $14 billion of automotive revenue pipeline, and incremental software licensing and subscription revenues over the next several years. So here's some risks to the price target. Although PC gaming demand seems resilient to macroeconomic weakness, any macro uncertainty could weigh on PC gaming demand trends, given NVIDIA's about 53% exposure to the PC gaming segment. Any consumer PC gaming weakness poses downside risk to our estimates. NVIDIA's GPUs could gain lower than expected deployment into data center applications as hyperscale customers further adopt deep learning as a new and effective way of processing large, unstructured data sets. Any significant decrease in the adoption of deep learning by hyperscale customers or increase in competition could result in the downside risk of our revenue and earnings estimates. And really appreciate this insight and work by Harlan Sur. Great job. I'm going to pull up the next stock we're going to take a look at is going to be Apple. And we've got Samik Chatterjee at JP Morgan. Love some of the work he does. Been following him for years. Their investment thesis is we rate shares of Apple overweight from the combination of AI and age of installed base led volume replacement cycle with services continues to demonstrate robust growth, delivering acceleration in earnings growth. That said, in relation to the bull case, without tailwinds from AI, we see the opportunity for investors to look for earnings growth through services growth and margin expansion to be the primary driver of share price returns while awaiting further visibility in relation to AI-led volume uplift heading into the iPhone 17 cycle, implying limited downside risk over the medium term. They've got a price target of $245, applying a multiple of around 30 times on current year 2026 earnings estimates. The multiple is justified as it's towards the high end of the range in which shares traded at recent years and largely in line with current multiple given robust growth. So the risks rating to that price target would be deceleration or concentration in handset and smartphone market could be faster than expected. There could be an increase in competitive pressures in international markets and potentially a new business cycle strategies. Acquisitions could be fruitless, so there's always a risk there. And then key man risk around the departure, potentially, we don't know when this is going to happen of Tim Cook, so we'll just kind of see because he's quite the leader in the space. All right, so we're going to jump over to AMD. So advanced micro devices. Harlan Sur covers that one. I'm just going to take a look at what he says there. Although AMD has improved its competitiveness across CPU and GPU products with Ryzen, EPYC, and Radeon platforms and is on track to improve its market share and drive meaningful revenue growth in the near term, we believe long-term share gains are less certain. In addition, AMD will have to invest heavily in operating expense, especially R&D, so research and development, in order to keep pace with the market leaders. While we are encouraged by AMD's execution, we remain neutral as shares appear to be nearly fully valued. I am neutral on the stock as well. They have a price target of $180 a share, assumes shares trade at about a 30x or 30-time PE multiple in line with peer multiples of 25 to 35, applied to $6 in second half 2025 annuals earnings power. Risks to the downside would be AMD typically derives 50% of its revenue from core PC end market, which is highly correlated with macroeconomic conditions. If the PC end market is stronger than expected, this could lead to a decrease or increase in microprocessor and GPU shipments, which could result in a downward or upward revision of our revenue and EPS estimates for AMD. AMD competes with Intel and NVIDIA in the microprocessor and graphics markets, respectively. Therefore, any material share gains or losses could result in upside or downside to our revenue and EPS estimates, which could cause us to reassess our neutral rating on AMD. Okay, let's try to do a couple more. Netflix. Let's take a look at Netflix. Doug Anmuth at JP Morgan, he says, we believe Netflix is a key beneficiary and driver of the ongoing disruption of linear TV, with Netflix's content performing well globally and driving a virtuous cycle of strong subscriber growth, more revenue, and growing profit. By the way, I would add that Netflix is kind of semi-immune from tariffs, so it's kind of a nice trade to make. I like the stock. So he goes on, he says, with 300 million plus global subs or subscribers, Netflix has a long leadership position in a rationalizing streaming industry, and we expect Netflix to benefit from global proliferation of internet-connected devices and increasing consumer preference for on-demand video consumption over the internet. Netflix's ad-supported tiers should further expand Netflix's subscriber base while driving high-margin incremental revenue. So on the valuation, we increase our December 2025 price target from $1,025 a share to $1,150 a share on 38 multiple of 2026 earnings GAAP EPS of $30.46, which equates to about a 42 multiple based on 2026's earning future cash flows of $11.7 billion. This is a premium to mega cap tech peers trading at around 28 times 2026 estimates GAAP EPS on average, which we think is justified by Netflix's similar top line growth and faster bottom line growth. And some risks to that target. Number one would be advertising efforts do not generate strong results, limiting subscriber revenue upside. Core subscriber growth slows, limiting Netflix's ability to further unlock its TAM, which is total addressable market. 3, Netflix does not efficiently balance top line with growth investments, limiting operating margin and expansion, future cash flow generation. Number 4, video streaming is competitive industry with low switching costs. Key competitors include Disney Plus, including Hulu or ESPN Plus bundles, Prime Video, Max, Apple TV Plus, Peacock, and Paramount. Less traditional valuation support versus large cap tech peers, and lack of visibility into near-term subscriber trends. So long as they do well there, I think that the price target is warranted. Netflix is basically eating everybody's lunch and is recession resistant. So let's jump to Amazon. So Doug Anmuth at JP Morgan covers Amazon. Their investment thesis: we believe Amazon is well positioned as the market leader in e-commerce and public cloud, where the secular shifts remain early. U.S. e-commerce represents about 20% of adjusted retail sales, and we estimate only about 10% of IT spend in the cloud today. We believe Amazon's flexibility in pushing first-party versus third-party inventory and Prime membership serve as major advantages in its stores business, and its multi-year head start in the cloud has led to about a 35% AWS global market share, which is huge. We believe Amazon is on track for multi-year margin expansion and future cash flow ramp, with Amazon targeting MSD percentage plus North America operating margins. High growing AWS and advertising revenue streams are Amazon's most profitable businesses, further supporting margin expansion and future cash flow generation. So valuation, we decrease our December 2025 price target from $270 to $220 based on 30 times our 2026 earnings free cash flow of $71 billion. This is a premium to Microsoft, Google, and Meta, trading at around 29 times, 20 times, and 21 times, given Amazon's faster bottom line growth profile. Downside risks are pace of AWS, re-acceleration and normalized growth trajectory. 2, state of U.S. consumer with macro pressures impacting spending levels. 3, Amazon's margin path is not always linear, with Amazon historically investing in growth. 4, Gen AI monetization is early and visibility is limited. 5, heavy competition across stores and cloud. 6, increased regulatory scrutiny could become a multi-year overhang. Less traditional valuation support versus mega cap peers. So there you have it for Amazon. Let's do Microsoft. 2 more. We'll do Microsoft. Got to get the Mag 7, right? I guess. Mark Murphy of JP Morgan. He is the analyst that follows that. All right. Investment thesis. Microsoft enjoys a broad portfolio of strategic products, sits at the intersection of digital transformations and cloud adoption, and CIOs view it as the most critical and indispensable IT mega vendor. Our positive bias on Microsoft is rooted in 3 main factors. Number 1, global movement towards multi-cloud architectures benefiting Azure. Number 2, Microsoft's linkage to large digital transformation initiatives based on our interactions with dozens of CIOs. And 3, favorable positioning for hybrid cloud architectures versus Azure stack. While Microsoft shares are valued at a premium on a PE basis, we believe this premium is warranted based on faster recent organic revenue growth, robust future cash flow generation, and relatively stronger position within enterprise, and our belief that Microsoft has pulled ahead of the pack with state-of-the-art cloud platforms. Valuation. So their $465 December 2025 price target for Microsoft is based on around a 30 times current year 2026 PE, which is at a premium to its peer comps, which trade at around 24 times on average. Tech comps include CRM, which is Salesforce, Amazon, Adobe, Intel, Apple, Meta, which is Facebook, and Google, which is Alphabet. The multiple is at a premium to comps to account for relatively stickier, more reoccurring enterprise software revenue streams, as well as long-term upside revenue potential being unlocked by AI capabilities, lower SBC expense yielding pure free cash flow than the peers, and materially less exposure to advertising, e-commerce, devices, etc. Compared to the peer group, Microsoft enjoys a large mix of renewable revenue, which typically earns a company a premium relative to companies with higher mix of transactional revenue, such as Apple. Our valuation is based on our relative value analysis of mature software companies and our expectation that Microsoft can monetize its recently developed AI capabilities to sustain durable top-line growth, helping offset incremental CapEx investments to build out its cloud and AI footprint, which may weigh on near-term free cash flow generation. Risks to the price target. Heavy competition in both consumer and enterprise markets. Investments in growth products may not result in profitability. Slower than expected leverage could result in EPS downside. Azure growth could decelerate faster than expected. I'm summarizing a lot of what he wrote there, but that is the gist for Microsoft. I still like the stock. It's one of my largest holdings as a firm, and that is not going to change anytime soon. Let's see. Final one is going to be Alphabet or Google. Doug Anmuth, he follows this one. He's the analyst for it. Investment thesis is we believe Alphabet's fundamentals are solid and the company will remain both a driver of and a primary beneficiary of an increasingly digital economy and advances in generative AI or Gen AI. Google remains focused on innovation, and we continue to believe that there's a healthy runway across search and YouTube ads, as well as AI drives higher ROI and TV dollars shift online. Non-ad businesses include cloud and YouTube subscription services. YouTube's just killing it. They have significant headroom, and companies within other bets include Waymo and Verily provide option value. We remain confident the company's ability to innovate around generative AI, control costs, and generate solid top-line growth. Valuation. our December 2025 price target of 195 up versus prior 180 price target is based on a 20 multiple of 2026 earnings gap EPS of $9.60, which ex cash equates to about an 18.5 times our 26 earnings gap EPS. Other bets of $10.09. We believe Alphabet shares should trade at a premium to the S&P 500, as Alphabet is one of the few companies in the S&P 500 with DD percentage, revenue, and EPS growth off a very large base and a strong 30-plus GAAP operating income margin. So risks to the downside include competition ramping across AI, ads, cloud, and for engineering tech talent. 2, potential for a return to heavy investment spending and margin compression. 3, regulatory scrutiny resulting in meaningful change to operations or limiting innovation. 4, growth slowing more than anticipated with the next major revenue drivers, including cloud hardware and Waymo, not materializing as expected. They're still a leader. I see they're an 800-pound gorilla. They're gonna be innovative, and I think probably acquire some companies, things like that. So that rounds out kind of some of these big tech earnings and price targets from analysts and some research, all that I like and agree with, and from both perspectives, whether it's positive attributes or risk to the downside. I think it's worth sharing what we read, how we follow it here at Northbound Wealth Management. Thanks for listening to this week's Market Insights. Hopefully you gleaned something new. And stay tuned next week. Like and subscribe.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.